Well, good morning, everyone. My name is Nina Dunn, and thank you for joining our webinar this morning. Joining me today is Lisa Salamon, Ellerston's Head of Distribution, along with Jason Coggins, our Head of Product Strategy. We're deliberately keeping today's meeting webinar to 30 minutes, just with a focus on the current macro environment in Australia, the AI productivity opportunity, and why we believe Australian small caps are set to benefit from this. As time is going to be tight, we encourage you to send through any questions you might have, and we'll answer them offline post the webinar just to make sure that we get the most out of today's session. If you'd like a copy of the presentation, please reach out. Our contact details will be on screen at the end of the session, and we'll send that through to you. I'm now going to hand over to Lisa, who's just going to provide a brief introduction to Ellerston before Jason shares his macro outlook. So, Lisa, over to you.
Thanks, Nina. You won't be hearing from me for too long, but I just wanted to set the scene for those of you who don't know much about Ellerston Capital. So we've been around since 2002. Out of the 60 or so staff we've got based in the Sydney office here, at least half of them touch money. So we're a very strong investment sort of focused house. The faces you can see on the screen here are the microcap team. So a mix of portfolio managers and analysts within the group. So what we like to say internally is we've got the wise eyes and young leads, which is really important as they're on the road for sort of 1/3 of the year. Our flagship fund is the Microcap Fund. It's been around since 2017. It's weathered many cycles in that time. As you can see, the performance is stellar across all time periods. So looking at that 6 month right through to inception, it's done really, really well. Lastly, I think one of the unique things to Ellerston Capital is the fact that we invest across the whole broad spectrum of things. So we start at the unlisted spot, we go right through from micro, emerging and into the mid-cap space. This gives us a really in-depth knowledge of our companies that we invest in over that time period. And lastly, if we look at the sort of top 5 stocks that we've got in the portfolio, these might not look very sort of common to you, and this is the sort of stuff we have access to. So we're a little bit different out there. Now I'm going to hand over to Jace, who's going to cover off what's happening in the environment here in Australia. He's going to look at sort of the opportunities we're seeing in today's market and why is it a great time to be looking at small caps. Over to you, Jace.
Awesome. Thanks, everyone, for joining. Thanks, Nina. Thanks, Lisa, for the introduction. So Ellerston is very unique. The family office legacy, the small company focus, that platform really enables us to look at companies in a unique way. This topic of today was really around the budget and the economy and some of the issues in the economy and how small caps are actually well placed to benefit from this. Now, whether or not we like it or not, confidence has taken a hit following the budget, but we're still a lucky country. And what we're going to talk about today is the Lucky Country 1.0 versus Lucky Country 2.0. 1.0 was really built on the 1990s reform in commodities. This still dominates, and we're still a wealthy entrepreneurial country. Lucky Country 2.0 will be driven by how we embrace AI, and AI is fundamentally going to change every aspect of our life. And we're uniquely placed to leverage this, given we have the 4th largest savings pool in the world. Politics aside, there's one strength no short-term policy can touch. We're a young country of small businesses. We're diverse, we're educated, we punch above our weight in a lot of different respects. Without the advantage of scale, being a small population, our companies have always had to think bigger and fight harder. Now add AI. These small companies can scale without cost. We believe the next decade will be an era of small and micro caps capturing almost all of the productivity gains on offer. I'd ask all of you to ask a serious question when you're making an investment in Australian equities. Do you think the ASX 20 is going to offer you the earnings growth going forward? Do you think the ASX 20 can implement AI efficiently? We've already seen instances where Uber and CBA have already said they can't justify the cost or can't justify or see the cost-benefit analysis of utilising expensive versions of AI. Knowing that, does it make sense to buy banks, insurers, and telcos, which make up most of the market? Do you also expect that large companies, bureaucratic companies, and also government institutions, are they going to take advantage of what we're seeing, a large dislocation in the pricing between US and Chinese models? No. But small caps can do that, and that's why they will gain the productivity advantages that large companies can't do. This thematic is still very, very early. Only 12% of Australian businesses have even started. So my challenge to everyone today is to ask the question, is the ASX 200, through an ETF or a low tracking error strategy, really the Australian economic beta that you want? Or would you want to be part of a market offering NASDAQ-like returns at less than half the valuation multiples? Let's go to the first slide. So it's not going to surprise everyone, but we have a productivity challenge in this country. In fact, we've gone nowhere for a number of years. Compare this to the US, where they've had a productivity boom. A big part of this is government spending. What we've seen over the last decade is the tax share of government spending across the economy has risen. Now, this has very important implications. The larger the public sector, the larger it crowds out the private sector, and the larger it makes it, the more difficult it becomes for the private sector to actually grow earnings consistently and be productive. The other aspect is where jobs have been created, and this is a terrible slide. It's showing that almost 67% of jobs have been created by the public service, and that's risen from 57% since 2018. In the United States, that's fallen from 45 to 40. And even in a market that we probably consider to be socialist, the European Union is lower than us. A big part of this has been driven by the NDIS, great program, but terrible execution. This has effectively crowded out the public sector. The public sector is effectively crowding out the private sector. What has this led to? So we've got more government spending, we've got low productivity growth. We've actually seen living standards decline across the economy over the last 3 years. Again, the contrast could not be even greater between the US and ourselves. And even Italy and Japan, with lower growth, their living standards have actually gone up. Now, if we look at the ASX, and again, I asked that question, when you're allocating to Australian economic beta, do you want to buy an ETF that's exposed to miners, to banks, to insurers or supermarkets? Or do you want to buy small caps that are best placed to actually build out the AI digital enablement and use AI to their advantage? The index is not the most efficient way to buy Australian economic beta. This is not a great index. And we'll take you through valuations. But if we look at information technology, which a lot of these names are in, it only makes up 3% of our index today. Now, what does this mean for the implications? So obviously, we've seen AI dominate markets and really drive growth in markets across the world. It really started with the Mag 7, the 7 largest companies in the US, went down to hyperscalers. It's in neoclouds now. It's in memory chips. We think the best opportunity over the next decade will be small companies who can deploy AI in their businesses. They are nimble. They don't have the bureaucratic clipboard warriors and the processes and the time that it takes to get things done. These are small businesses who can put AI into their business to drive productivity growth. However, the opportunity is only just starting. A survey of Australian businesses show only 12% of companies are actively using AI in their business today. This will grow, and this will lead to ultimately productivity growth. And productivity growth is so essential in this economy, and AI is the opportunity here. 12% of companies have embraced AI. There's a lot more to go. So we're going to take you through Lucky Country 2.0. We haven't had the productivity reforms over the last decade. Our government has become bloated and our living standards have gone down. However, we're an extraordinarily wealthy country. Lucky Country 1.0. We have a significantly large pool of capital in our superannuation. And if we look at our neighbours across the Tasman, we're significantly wealthier. And we have had a significant increase in wealth over the last 20 years And what this enables us to do is to invest in AI and invest in the data centers and pool capital to drive that productivity growth. And we know that at the moment, the vast majority of economic growth, both in the US and both in Australia, is around the rollout of data centers and digital enablement around AI. In the US, it's around 60 to 70% of growth that can be linked to CapEx related to the sector. In Australia, we would have gone backwards if it wasn't for data center related CapEx. Now, there's something really interesting and what we would like to talk about small companies. There are a lot of companies out there that have given access to their workers with various AI tools, only to find that they're burning through tokens and burning through cost very quickly. Uber, CBA, they're using their AI budget that they expected to spend over 12 months in 1 month. This dislocation here is between Chinese models and US models. The Chinese models have come out of nowhere and are as good and potentially soon to be better than US models. Now, why is this important for the small company versus large company concept? The large companies are not yet going to use the Chinese models. Small companies can. Small companies will look at this and see a massive cost advantage and be able to implement AI at a significantly lower cost than what larger companies will do. Now, what I also find interesting here is that Singapore has just announced that its preferred large language model is Alibaba. So an ally and part of the West is using Chinese large language models. So the cost advantage that some of these models have is incredible. And so if you're a small company, you might use Claude for large complex tasks, and you may use a Chinese model for other tasks. Kimi came out of nowhere. Kimi was announced last week. It has a score, an intelligence score of 57 versus 60 for Claude Fable 5 at a significantly lower cost. This is another factor that underpins the productivity opportunity for small caps. Their ability to be flexible, their ability to think about costs. Large companies are struggling to implement AI at a reasonable cost. Now, if we look at slide 21, this shows the index returns last year of major markets around the world, and it also shows the valuation metrics of smaller micros and the ASX 200. The smaller micros is a universe of quality and growth companies on the ASX. So financial year 2026 was a fantastic year for returns. We saw the NASDAQ rally nearly 30%, but we also saw the ASX micro small cap index rise by 28.6%. Now, if we look at the ASX 200, we were a laggard. Our large companies were some of the worst performers globally. The ASX 200 was really only up 2.8%. The opportunity here is to access high-quality companies with strong earnings growth that's matching some of the best markets in the world. Now, let's look at valuations on the left-hand side. This opportunity set, we're not paying up for it. So we have a forward PE multiple on the small and micro quality growth universe of about 14 times 1 year forward. That compares to about 21 times for the ASX 200. ASX 200 is still expected to generate growth, but you're paying a 40% higher multiple for 1/3 of the economic growth. Now, while the ASX micro and small cap index performed really well last year, it's still trading at extremely low multiples. Next slide shows that ratio. So if we look at high quality small companies, we match the S&P 500, we match the NASDAQ, and we're doing it at almost half the price of the S&P 500. So 14 times PE, 26% growth for Australian small and micro caps. For the S&P 500, we got a pretty high multiple, but pretty high growth, high quality index, high quality names. The ASX 200 is a complete laggard, right? very high multiple, more expensive than the US market, and offering really only 11% of growth. So I go back to that question. When you're allocating to the Australian market and you're allocating to primarily large companies being the resource companies, the banks, Telstra, insurers, all the legacy type sectors that reflect the old economy, you're buying these companies that don't have the growth prospects that smaller companies do. Whereas the smaller companies, and we can look at them in two ways related to AI, they will build the infrastructure for the AI rollout and the data center rollout. And they will also be the companies that can embrace AI into their day-to-day tasks to drive productivity growth. Just some of the examples before we get into why active small caps. We've been talking to a number of companies around the market around how they're embracing AI. One example, we were speaking to a fund manager based down in Melbourne. They were looking at releasing a new fund, which required a new IM. They have two legal firms on their panel. They had a quote of $100,000 to publish that IM. They said that's pretty expensive. They then used Claude to write 90% of it and went to their the second legal firm on their panel, and they were offered a quote of $10,000. These are the small things that small companies can do. In other examples, small companies are often no longer employing as many accountants, as many legal professionals. AI is coming through the system fast. It's coming through and changing the relationship between capital and labour. And small caps are the ones where that opportunity is the greatest. Now, we are really big believers at Ellerston. As Lisa said, our business is really based around small companies, and we have a very, very unique platform of both private and public companies. We look across the spectrum, micros, smalls, mid caps and large caps. It gives us a really unique advantage that's probably unmatched in the marketplace. We also have one of the largest teams in the marketplace. And you need that because it's actually a really interesting market where active managers can add significant amounts of alpha against their benchmark. Now, there may be a criticism here that the ASX small cap index is a low quality index. So it's easy to outperform. And that is partially true. It's partially true because there's a lot of unprofitable companies there, and there's also a lot of resource companies that don't make money. However, if we go back to the idea that over the long run, active small cap managers have actually outperformed larger companies. And if we look in the next decade, where we believe small companies are going to have the productivity boom that the country needs, we're getting exposure to a sector where alpha is available, and we're getting exposure to a sector that is really going to be able to harness that productivity gain. Now, at Ellerston, we're really focused on one part of the market, and that's really the industrial side. So we avoid resources. We believe to be good at resources, you need a completely different skill set. But most importantly, you need to accept a lot of volatility. And what this chart shows is the drawdown of the industrial side versus the resource side. So you would be probably surprised to learn that resources are still below their high watermark since 2028. They did recover those losses from 2028. Last month, they gave those up. It has been in a serious bear market, and it took 17.7 years to reclaim their peak. We think the opportunity set, particularly around AI, and particularly around the opportunity to build AI and to harness the productivity benefits of AI, is going to be driven by the small cap universe. And almost all of those companies will be in the industrial side. Now, if we look at what this means in terms of some metrics, if we look at the small cap top quartile, it has been by far the best part of the market to be involved in. Even the small cap median manager has been a great place to invest in. It is outperformed the ASX 300, and it's outperformed by a meaningful amount. Now, these are obviously backward-looking statistics, I would say let's think about the forward-looking statistics. We're being offered a very unique opportunity to buy a cheap part of the market, despite it having gone up by nearly 30% last year. It's a part of the market that is going to benefit from this productivity boom related to AI. And right now, these companies in small cap land and in AI are the ones who are building out this AI and digital enablement. So it is a very exciting sector to be part of. So, Lucky Country 2.0, we really started around the concept that Australia is a very wealthy country, and we're still a great country. The underlying base of Australia is still very strong. We have a great education system. It's a great place to live. We produce great small companies. We have an entrepreneurial and innovative culture. We have world-class universities. While the budget has created a lot of uncertainty and the economic landscape is challenged, a lot of these companies in the small cap space are actually less sensitive to the economic beta. And the economic beta of Australia is largely expressed in portfolios through large caps. And in our view, that is not the place to be. You're paying high valuations, you're getting low quality earnings, and you're getting companies who are not going to be able to use AI to their advantage. We have, a culture of small businesses. 90% of all firms in Australia are small companies. And they're, again, I'm going to stress the point, they're the ones who are going to capture the AI boom. So putting this all together, what does this mean? If we look forward, we have an opportunity to invest in small and micro-cap companies. These are building AI. These are gaining productivity advantages. We're able to do this at Ellerston because this has been in our DNA for 20-odd years. We are a small-cap house. We are a very well-resourced team. And this is the opportunity. Buying cheap, high-quality, high-growth companies that are really going to be able to harness AI to their advantage.
Thanks, Jason. Gosh, there's a lot of information that's gone into that short amount of time. We're going to actually finish here a little bit early, which is great. So we'll give you some time back into your day. Again, if you'd like to dig deeper into any of these things, if you'd like to have a meeting to see how the microcap fund would fit into your clients' portfolios, we'd love to continue all these conversations. Send us any feedback as well. My details, if you scroll through names, my details will come through on the screen. Please send me an email. Reach out. We'd love to have a chat. And just thank you again for joining us this morning because, your time is precious and we really appreciate it. Thank you all.
Thank you.
Thank you.